The U.S. Federal Reserve seems to have found its sweet spot with rates for now, at least. And the path of rates in 2020, well, that's going to depend on how jobs data evolves and what happens with the trade war. So instead of focusing on the possible path of rates in 2020, we want to try to shed some light on the rhetorical question of whether the Fed would ever adopt a negative rate policy, as has been done by the European Central Bank and the Bank of Japan. Negative rate policies have been controversial from their introduction. The ECB and the BOJ adopted a linear argument. That is, if moving from 3% to 2% to 1% short-term rates was increasingly accommodative, then moving rates to zero and even in a negative territory would be even more accommodative and stimulatory for the economy. Banks would be encouraged to expand lending, and the resulting increases in business and consumer spending would mean stronger economic activity and higher inflation. Another camp, of which I'm a member, from the beginning, this camp rejected linear thinking and argued that negative rate policies are simply a tax on financial systems. The tax would hurt profitability, end up weakening lending, and damaging the economy. Many banks in Europe are massively scaling back. Europe has entered a recession, Germany's in a recession, Japan continues with relatively sluggish growth and no signs of inflation. A couple of points now. Negative rates are not a sufficient condition to encourage large amounts of negative yielding debt. That takes the additional policy measure of massive government bond purchases by the central bank. The BOJ has bought about half the supply of Japanese government debt, and the ECB has bought between 20 and 33% of the sovereign debt of EU countries. More or less, there's about $13 to $15 trillion of negative yielding debt securities outstanding. Signaling is important. One of the main consequences of negative rates and negative yielding debt has been to send a signal to market participants that the central banks have an extremely pessimistic view of the future. One has to pay a penalty just to preserve the capital value of sovereign debt. Many think this type of signaling feeds a savings mentality that discourages consumption and economic activity. Liquidity matters. Another consequence of negative rates and negative yielding debt has been to dramatically reduce the liquidity of government bond markets and in turn raise the costs of interest rate risk management. Liquidity to an economy is like oil to an internal combustion engine. It reduces frictions in the economy and allows the price discovery and interest rate risk management processes to function efficiently, and that leads to a more optimal capital allocation and enhanced economic growth. So now to our question. Would the Federal Reserve ever adopt a negative rate policy and expand asset purchases with the intent of driving bond yields into negative territory? Now, one cannot rule out negative rates in the U.S. because the Fed never likes to take an option off the table. Indeed, if you're interested, there's a recent economic note from the Federal Reserve Bank of San Francisco that makes this point. Nevertheless, the Fed seems highly unlikely to adopt such policies even in a deep recession. The preponderance of evidence tilts heavily against negative rates and negative yielding debt. If a recession were to develop, the Fed would probably quickly move to near zero rates, and it would restart its Treasury note and bond purchase programs. We also note that during the Great Recession back in 2008-2009, the Fed created a variety of tools it had never before even considered. It created special purpose vehicles and lent them over $75 billion to buy distressed assets from the financial system. It created special arrangements to support the insurance company and government-sponsored mortgage agencies. It created emergency term lending facilities to keep financial institutions afloat. These were powerful and targeted tools in the Fed's effort to restore the financial system to health as quickly as possible and to keep the recessionary pressures from becoming a vicious cycle, taking the economy into a depression. The Fed is much more likely to use ideas, as appropriate, from the 2008-2009 playbook in the next recession than it is to adopt negative rate policies. I'm Blue Putnam, Chief Economist, CME Group.